when I started investing, I thought that just pulling out some filters, adding some metrics, and I would be good. As I've grown up as an investor, I become more sophisticated. And then I looked into quarterly earnings. That helped me add color to my investment thesis and, of course, avoid a lot of mistakes.
Fellow investors, bonjour. This is Mike Leroux, founder of Dividend Stocks Rocks and passionate investor. You're listening to the Dividend Guy blog podcast, where I and my co-host Véronique will help you invest with more conviction so you can enjoy your retirement.
Dividend Gold investors, bonjour. Mike Leroux here. You're listening to the Dividend Guy podcast. I am with my co-host Véronique. How are you doing today?
Well, Mike, first of all, I'm glad that you're all grown up as an investor. That sounded cute.
My wife would disagree about the rest, but at least as an investor, finally grown up.
And also, second, I have like a quick announcement to make. It's my wedding anniversary today as the podcast is released. So, yes, I'm glad that I'm still married after all these years. So. Hello,
yeah, especially after the story you just told me before we started recording, when your husband almost lost a wheel while driving to work, and you had to spend the entire day running around. So yeah, you must really love Max. So Max, if you're ever listening,
he was so angry, but I was still happy that he was still alive. You know, that would have been worse.
Yeah.
All right, so back to our episode. Mike, the last month of an earnings season is always busy, and we are entering the last month of Q3 currently. At Dividend Stocks Rock, a couple of analysts, including yourself, go through quarterly results to give our pro members the information they need to know what's going on with their holdings. So today we'll share that process of analyzing earnings with listeners so they know what to focus on, how to avoid traps, and how to invest with conviction.
Yeah, so while most companies have already reported their earnings at the beginning of September, this is our crunch season because now we have to cover over 1,000 companies, and the earnings season is going to start very slow, with a few financials from the US side. And then there's kind of that wave building. And then by the time that we are getting to September, all the companies have reported mid-July and in August. And now we're just not able to keep up. So we're pretty much in the crunch time right now, where we have to review dozens of companies almost daily. But I mean, it's going well. It's just that it's a lot of work to be put in at this time of the year.
Right. So first, Mike, we've mentioned doing a quarterly review of our portfolios repeatedly on the show, but can you remind us why it is a crucial step for DIY investors?
Yeah, so we decided to do this episode mostly to kind of walk you through how we review those quarterly earnings. Mm-hmm. And I think most of the time, the investors are making a huge mistake thinking that everything is the same forever. And so many times I've heard that whenever I raise concern about a company that is beloved by investors, very popular, they're just answering me, but Mike, you don't get it. You should not be concerned. They've been around forever. You don't have to worry. So just for fun, I was looking at the S&P 500, the top 20 companies in 1990. So not 75 years ago, but just a quick 34 years travel back in the good old days where the Canadians actually had a chance to win the Stanley Cup back then. I still remember that in 1993, I was trading bubble gums during the playoffs with one of my friends that he thought that he was betting on Gretzky scoring, and I was betting on the Canadiens winning. So we ended up almost as a draw because Gretzky was always scoring anyways. But anyways, so just to say, among the top 10, back in 1990, we had the largest one was ExxonMobil, IBM, Lowe's, Raytheon, Bristol Myers, Merck, Coca-Cola, Walmart, GE, and Procter & Gamble. Of course, a lot of those names are still active today, but none of them are part of the top 10 of 2024. Now we have like the Apple, the Microsoft, Alphabet, Amazon, Nvidia, Meta, Tesla. There's Berkshire Hathaway that was not too far in 1990 that is now in the top 10, Eli Lilly, and Visa. But just to show you that in 34 years, those companies are completely different. And now I'm just talking about like some dividend payers in the 90s that are not even probably existing today. So thinking that everything is the same all the time is a big mistake. And instead of like doing a spot check like every 5 years and missing on a lot of information, just doing a quick review every quarter will tell you if anything needs to be made in your portfolio in terms of actions or if it's in true business as usual.
So it may seem obvious, but the press release contains most of the information investors need for their quarterly review. But where can we find it?
Well, I guess the best place to find them is in the DSR Pro report, right?
Of course.
Yeah, I mean, jokes aside, because we
But
like
it's
at
true.
the end
I mean,
yeah, I mean, at the end of every quarter, all our DSR Pro members, they have the ability to generate that report where they have a summary of all those earnings and a link to the quarterly press review. But I mean, if you're not paying for any services, there are like two ways that you can do it. You can look up on the company's investors website, which is probably the best way to do it. The downside is you have no clue when they report their earnings, so you have to track them, maybe make yourself a small calendar. So that could take some time. Again, at DSR, we do have all that information in a stock screener where you just can filter by sector and then you will look at all the earnings date. Or you can use a free aggregator such as Seeking Alpha. So Seeking Alpha is probably one of the best places to find the company press release. And then you'll have like some small comments sometimes on like the biggest companies. Where Seeking Alpha editors will add a few notes. So that could be interesting. But definitely the best place to start your research if you don't want to pay for any service is the company investors website.
And we have to mention, Mike, that on Seeking Alpha, it's very easy for American companies, but not that necessarily obvious for Canadian ones, right?
They actually started about a year ago. Now they cover most of the Canadian stocks, and you can find the information. Yeah, it's not always easy, but most of the time, like the common suspects, their usual suspects are all there. So yeah, you can definitely use it. Now, of course, I have like a paid version, so I'm not too sure like what exactly you can get for free, but you can definitely get some of that information without paying anything. So that's a good start. But again, that's why I always tell investors, you know what? If you don't want to pay, that means that you're going to pay with your time. And if you're about to pay with your time, you're better off to go directly to the real source instead of like reading articles on Yahoo Finance or any other places. Just go to the company's investors website because you will not only find a press release there, and we're going to talk about other tools that you can use, but you're going to find the annual statement, the investor's presentation, most of the time the earnings calls. So you're going to have a lot more information if you want to dig further and if you have more questions.
All right, so in the press release itself, we can find financial highlights, business highlights, and financial statements. What does each section tell investors and what should they focus on?
So before we get there, always keep in mind when you read anything that is coming from the company, they will sugarcoat everything because they want to sell you that it was a good quarter. One of the best examples I can think of is at the end of August, TD reported their earnings. And of course, they're stuck in that anti-money laundering investigation. They took another 2.6 billion in provision. So now they're up to 4 billion in provision for the AML investigation. They don't know how it's going to settle. And when you look at the first quote from the CEO, the guy was just like, oh, we had a record quarter for the personal and commercial banking activities in Canada. So completely just say, oh, look the other way. Like, don't tell, like, we're not going to talk about the AML yet. We're just going to tell you how good their banking in Canada is, which was not the issue. And as an investor, this is not what you want to hear, because of course, that part of the business was A, business as usual, and B, doing pretty well. But this is what they're going to put up front. And of course, they will have to talk about the AML issues and so on. But that is going to be later on in the press release, not the first thing that, like, not necessarily in the financial highlights or in the business highlights. Sometimes they will just have like one line because it's kind of like a big highlight, even though it's a bad one. So the key here is to read the first page, knowing that they're going to try to sell you, it's a good quarter, but at least you get the good overview. So if there was any dividend increases, any acquisitions or divestiture or any major thing that happened during the quarter will be shown on the first page. And then you'll have like the quick summary of the financial statement. So you'll see how revenues has moved. You will see like which segment performed, which other didn't. The earnings per share will be there as well. So it's the right place to see if there's something off. That would be the starting point of an investigation, or simply just a good old quarter with everything is as usual and you don't have to worry too much. So in the TD case, when you look at it, you're just like, okay, so everything is fine besides AML. So now that's your red flag. Now you need to investigate a little bit more. And this is where you're going to go outside of the press release.
So, like you said, it happens that the press release isn't enough. So when it does, what other sources of information should we look for?
So from the press release, you will have the ability to write down the questions that are unanswered. So that's why I always start with the press release, because sometimes you're going to save a lot of like headaches to dig into the financials because everything will be good. Now, if you have a few questions, then it's time to go into the real financial statements, not just the press release, to read about the notes. It's daunting, it sucks, it's boring, but hey, if you want to know exactly what's going on, you have to dig in a little bit more and put a little bit more extra work. And this is what we tell investors when we tell them to do their due diligence. That's what we're talking about.
Right.
So staying with the bank example. So of course, for the AML, and of course, there's also the provision for credit losses that is a little bit more complicated. So you see the big numbers in the press release, but then if you really want to see what's going on, you will have to dig into financial statements. And this is where Control F will be your best friend, because of course, those financial statements could be like 50, 80, sometimes 100 pages. So you don't necessarily want to read the whole thing unless like you have really nothing to do and it's like keeps on raining. So as we enter fall, maybe for the next quarter, this is what's going to happen. But still in September, we have some sunny days. So you might not want to spend your entire day looking to financial statements. Another place that you can get that information as well. And what I like about it is you're going to get graphs, so a little bit more visual. So it's going to be less daunting and a little bit more entertaining, is the investor presentation. Once again, those are like decks of slides that are made to sell you that it was a good quarter. So of course, you're not necessarily going to have like the main highlights, and the first slides are going to be positives. And later down, you will see how, for example, provision for credit losses or more details on the AML investigation, they will appear at one point or another. And this is where you can start digging. There's nothing better than having numbers, but at least when you have graphs and visuals, it's going to start helping you make up your mind about the situation and where it's going. But definitely, if you have specific questions, you will have to dig in the financial statements. I did that for the PCLs over the past 2 years for banks. For Bell, for example, BCE and TELUS, I had to do that to look at the interest charges to see how they were increasing from one quarter to another. So that won't be found into the press release, but those are like really specific questions.
And as an analyst, you want to know basically, Mike, if the dividend triangle is healthy, right?
Totally. That is great because you have like one quarter of information, and then you will also look at the bigger picture, because the dividend triangle is the graph for the revenue trends, earnings per share, and dividend. So you don't necessarily want to take your decision based on one bad quarter or one good quarter. Sometimes the market will react heavily on like either like super positive or super negative. We saw Starbucks crashing by 20% couple of quarters ago on bad sales numbers, and then the following quarter it jumped by like 20 something percent because they changed their CEO. So instead of like looking for one-time event in a quarter and it's going to go crazy, what I want to do here is to look at the trends, that because it's going to tell me a story. For example, if revenues are flat for this quarter but earnings per share is up 10%, what does it tell you? Well, it tells you that they probably did something with the margin. There's definitely something here that will improve the profitability because they're not selling more of what they're doing. Then again, you can say, well, that was a good quarter, but is it sustainable? Probably not. There's a limit of like just think about your budget. You want to save like $100 a month. It's probably easy. You call your cell phone company, you look at your insurance, you cut down on grocery bills and stuff like that. You're going to cut off that $100 a month. But every year cutting $100 a month, at one point it's going to be very tough. Or you're going to leave your husband on the side of the road and you're going to tell him, well, now you don't have a car anymore, so you're just going to go up with a bicycle.
Right. But Mike, you just mentioned the EPS, and sometimes EPS is misleading. So in which cases does it happen, and what metric should we replace it with?
You cannot go too fast reviewing earnings per share. First, you're going to have the GAAP EPS and the adjusted EPS. And of course, some people are cynical and they're just saying that adjusted EPS is, again, to sell you a better quarter, but it depends on the explanation. So the GAAP EPS is following accounting principles. So really, like literally just following the accounting rules, and you get to the bottom line. This is what your profit is, and it's over. Again, I'm going to take TD's example because this one was just perfect for this podcast. The GAAP EPS was actually negative. They reported a loss this quarter. Why? Well, of course, if you're taking 2.6 billion in provision, that's going to hurt your profit a little bit. But the adjusted EPS was up 5%. So what happened is they will take away all the one-time event to get the right EPS number. So it's interesting, but what is very important here is to always look at the same number, with the same calculation. So if you're looking at adjusted EPS, just look at them every single quarter the same way. So then you will see if there's a trend going up or going down. Then there are other companies that will not use earnings per share at all. An obvious one would be REITs. Like for REITs, EPS is completely useless. We're going to focus on funds from operation per share. In doubt, because I know it could be complicated, especially if you're starting to review companies and then you're just feeling overwhelmed already. Well, when you're in doubt, you can look at the press release and the investor's presentation and look at what companies are focusing on. So if they don't focus on earnings per share, but they rather put a full slide explaining how they calculate distributable earnings per share, for example, like Enbridge, well, then you'll know that this is what they focus on. This is how they calculate it. And this is the number you have to track every quarter, not going from EPS one time, FFO the other time, and then distributable earnings another one. You're just going to go with a bunch of numbers that don't mean anything. Right. Brookfield Renewable and Infrastructure will also go for FFO per share, and they will explain their calculation as well. So it's important to understand that anything that is not earnings per share is probably not based on accounting principles, and it's kind of like the homemade calculation. So it's crucial to go into the details to understand how they calculate it, and also making sure that one quarter to another they use the same calculation method, because you really want to compare apples to apples here. This number will tell you how much they're making money going forward. So it's really important to understand the context behind it, so how it's calculated, and also the trend, regardless if it's going up or it's going down.
And this is why I like my DSR Pro report so much. It makes my life so easier.
Yeah, definitely. I mean, having like when you pay for a service like this or any others where you have like somebody else giving you additional explanation and context, you don't have to spend an hour to review this and ask yourself like all those questions. But again, there's nothing free in finance. So either you pay
Mhm.
with money to get a service, or either you pay with your time to dig in and make up your own mind about a quarter.
So once investors look at the overall dividend triangle trends, we want to make sure that the dividend is safe. Of course, the dividend growth is a good indicator. If they keep on growing, it means it's not going that bad. But still, the payout ratio and also cash from operations can tell us more, right?
Yeah, definitely. Again, the trend is your friend, so you don't necessarily want to take rash decision on one single quarter, especially if you see a quarter where the payout ratio is 100%. Then you may panic and say, oh, there you go, there's a problem. Then you need to, again, dig a little bit further to put context around that number and understand what really is going on. So the trend on the payout ratio is really important. So you will see if it goes up or it goes down, or it, like in perfect situation, it would remain about the same.
Mhm.
As the dividend increases and the payout ratio remains the same, this means that the earnings per share will increase accordingly. So that's great. Again, the dividend triangle will tell you that story up front. So the cells are like the revenue trend will tell you if the company is thriving or not. The earnings per share will tell you if they're profitable or not. And the dividend growth will tell you if the dividend is safe or not. So if you
Mhm.
see that the dividend is slowing down and then you dig a little bit further and you see that the payout ratio now is at like 90% and it has been 90% for the past 3-4 quarters and it's going up from versus last year, now you're starting to get a little bit more worried. And then you can look at cash from operations, and then you realize, oh, this generates less cash from operation than last year because inflation, interest charges are going up, and it puts additional weight on the company. And after all this, there's a big, and that's always the gray area. You have to determine if it's a quarterly thing or a yearly thing, like a
Right.
temporary moment, or it is something that has a high chances of repeating itself for several quarters, several years, and the company is definitely not going towards the right direction. And unfortunately, there's no like magic trick here. It's really a mix of the analysis of all the numbers and the narrative you have built up around that company, your investment thesis. But at least it's giving you some hints, because at one point, if you still believe the company is amazing, but the numbers are not, at one point you will have to face the truth that you're probably wrong about your thesis.
Mhm. Hey, listeners, you have heard us talk about DSR so many times. I think it's time to invite you to join Dividend Stocks Rock and become part of our great community. At DSR, you can rethink your portfolio with our portfolio models, buy the right assets with our stock cards and stock screener, stay the course, grow your conviction, and get educated with our weekly newsletter and exclusive webinars. What else could describe this risk-free investment, Mike?
So in 2017, I took 3 major decisions. I quit my job at the bank, I decided to go full-time on DSR, and I decided to manage my portfolio account. So that pension plan was $108,000. I was about to invest it at a all-time high market, and thank God I had DSR tools to help me out. So over the years, I've built a platform to help investors invest with more conviction, giving them clarity and make it easy to invest and manage their portfolio. Fast forward today, this portfolio is now almost at $300,000, and it makes it so easy to just use a DSR Pro platform to manage a portfolio, buy and sell, and do everything within minutes.
And you know what, listeners? We have a special offer for you. Subscribe to DSR now at thedividendguyblog.com/deal to get a 15% lifetime discount. That means your membership will never increase. Again, thedividendguyblog.com/deal. See you soon during our next private webinar. So let's talk about that narrative. So far we have mainly focused on numbers and trends, but the next step is the most important one. Like you said, it is to make sure that your investment thesis and the numbers match. But Mike, how do you do that?
It's not easy. So first, the narrative or the investment thesis is really all the reasons why you want to have that company in your portfolio. So it is the understanding of the business model, it is all the growth perspective, and you also understand the risk, but you're thinking, oh, they can manage the risk. They have like plenty of growth vectors, and it's going to be an amazing company going forward. Now, if you want to verify that with material coming from the company, they will probably be on your side. So you will suffer from the confirmation bias because the CEO comments will definitely tell you that they have had an amazing quarter. The investor's presentation is going to highlight all the positive graphs at first. So it's going to be a bit tough to have a complete story here. So how you can make sure that your narrative, your investment thesis matches the numbers and it still makes sense. Well, first, look at the dividend triangle. So if you're thinking about any risk and then you see that it's being reflected on bad earnings, well, then you are in a better position to say, well, if the management is able to turn that around or it's going to continue. So for example, Starbucks is struggling to generate higher comparable sales right now. It's declining. So now you're at this point where the news is up. It's been 2 quarters in a row. So it's tough to determine if it's going to be a long-term problem or not. So that's up to your judgment and that's up to what you think. So what you could do at this point is take a note. Say, you know what? Now I'm giving Starbucks X amount of quarters to turn that situation around. So what you can do using the press release and the investor's presentation is see how they address this problem. If they completely ignore it, that's a really bad sign, because if you catch it and they don't want to talk about it, that's probably bigger than you think. But if they address it and say, oh, well, we don't have like good comparable sales, but we are putting stuff in motion. We have like promotions happening, new products happening. We have like refiner application or whatever but at least they're telling you like ways they intend to address the problem. So you can say, okay, so that makes sense. I buy that, or I don't buy it and then I'm gone. And you can give them like a few quarters to see if those new measures are actually working. So we saw over the past few years, a lot of companies, they were talking about cost-cutting initiatives and programs because of inflation and so on. So today it's time to see, well, those companies that have been talking about this for the past 2 years, have they been able to improve their margin? Is the earnings are coming back? And if it's the case, well, then good news. They delivered on their promise. They faced the challenge. They found a solution. They applied it and it worked. So everything is fine. You keep on going. But some other times it's not working, and then more red flags are arising, and you always have to match that with numbers. So if the red flags are there and the numbers are weaker and weaker quarter after quarter, now you're getting to a point that it's probably time to let go.
So Mike, what are the main pitfalls to avoid when doing our quarterly review?
I would say the first thing is to be complacent. First, we have like plenty of reason to like think that everything is fine because the stock market has been almost going up every single year since 2009. So it's kind of like super easy to make money in our mind. And whenever we had the bad years, such as like 2018, 2020, and 2022, well, it took like 12 to 18 months to fully recover and go back into full growth mode. So a lot of investors are just thinking, yeah, that's just like a small thing. Just forget about it. It's all going to be fine. So overlooking the problem is probably number one. The CEO will not help you. And I remember before COVID, I reviewed some energy companies where the CEO was saying everything is good. You don't have to worry about the dividend. Everything is safe. And then like 3 months later, they would like slash the dividend by 50%. So you cannot trust this guy to tell you if it's going something wrong or not. They will even like push the envelope up to the point where when they announce a dividend cut, they will talk about financial flexibility, strengthening their balance sheet, moving forward with more cash flow. So they make it sound like it's the best thing ever that happened to the company. Yet you suffer a loss of income and likely a loss of profit in your portfolio as well. The other thing is, whenever there's an itch, you have to make sure you go deeper and scratch that itch. You have to find answers to your questions, and not just like a one sentence answer, but something a little bit more details. If you have a lot of companies, that could be another problem, because you're going to skip some of them, or again, it's going to favorize the fact that you're going to overlook some of those companies.
Right.
So make sure that if you have like 50, 60, 75 companies in your portfolio, that you actually truly enjoy monitoring them quarterly. And then for some people, it's a hobby and they love it, and that's perfect, and there's no problem there. But for most of us, we have other passions, we have other hobbies, and it's kind of hard to make time enough to go for all of those companies. So keeping it simple is definitely better. But yeah, so you will have at one point to go into those financial statements and read the notes to understand where that money is going and what is happening going forward.
So maybe you've written in your retirement plan that you want to spend 40 hours a week reading about earnings, press release, and all that, but maybe not. So you have to consider it.
It usually depends on your spouse, right?
Listeners, I hope you enjoyed the episode so far, but I have to interrupt it a minute. Our goal at Dividend Stocks Rock is to help you invest with more conviction. We know that dividend income is important for you, and this is why we have gathered all you need to know about it in the Dividend Income for Life guide. Right, Mike?
Yes, I have a completely different approach when it comes down to generate dividend income, and I wanted to share my view with that. I wrote a series of DSR fundamental newsletters that were greatly appreciated by our members this year. I received tons of comments, and a lot of them were, Mike, you just came out with some very thought-provocative concepts, and at this point, I really want to change my portfolio and follow this path to a better type of dividend income. So I've did a great review of those DSR fundamentals newsletters, packaged them together, wrote a few more pages of content, and built that dividend income for life.
This guide, as you said, has been highly rated by our DSR members, and we share it for free with you today. To grab your copy, hit pause on your app, visit thedividendguyblog.com/income and enter your name and email. You'll then receive the email with your download. And also, by the way, it's always a pleasure to hear from you, so please let us know how it helped you. Again, thedividendguyblog.com/income. So, Mike, do you always go all in into that process? Can you give us maybe like an example of a company that you reviewed quickly this quarter and another that needed more digging?
Yeah, of course, you don't go all in like 3-4 hours per companies for every quarter. That doesn't make any sense. And of course, and on top of that, it's probably just a waste of time. So there's a time management here that is really important. So when a company reports a business as usual, like they meet expectations and there's a good triangle and there's nothing really crazy that is happening, well, then you can move on to the next one. Like, for example, a company like Procter and Gamble, they will go through several quarters without having something super interesting to say. They're going to say, oh, like beauty and personal care is up like 4%, and then the last quarter was up like 3%. And I mean, you don't expect those companies to grow double digit. So if they grow like in a stable way, that's fine. And then sometimes there will be like one off number, but it will be easy to find the answer. So again, with Procter & Gamble, we know that they generate about like half of their revenues are coming outside of America. So of course, they will be facing currency headwinds. So sometimes they will say, oh, revenue's down 2%, but then you read a little bit more and you realize that organic growth is up 6%, and they were just facing like a huge currency headwinds that explain why revenue reported in US dollars is down, but overall the company continues to sell more of their products, but they have absolutely no control over currency. And for one quarter, it's going to be a positive item, and for another one, it's going to be negative. So then again, that's business as usual. So you don't need to spend that much time on it, and you can quickly go over it. I've briefly mentioned BCE, Bell, earlier today in the discussion, and this one I had to do a deep dive, and I'm still monitoring this one very closely, to be honest, because I'm not impressed this year with the quarter. We did a few episodes on that, and I explained as well it's important to look at all the cash flow metrics. So we're talking about cash from operation, we're talking about capital expenditure, or also known as capex, so the money that they spend on projects, buying spectrums, maintaining their wireline and wireless services. We have to look at the free cash flow. We have to look at interest charges that is going up. So all of that will tell you about BCE's ability to pay a dividend. So it's a long story. It's a lot of numbers to follow, and you have to make sure to understand what's going on here, because especially right now, like the cash payout ratio for Bell is most of the time around 90% or even worse, depending on the quarter you look at. So definitely not telling you that they're going to increase their dividend by 10% next year. That's like pretty much the opposite. So this is a good situation where you see the dividend triangle is not that great. It's been a few quarters that it's not good. And when you dig deeper, the numbers are not giving you a good answer either. Well, this is where I'll spend maybe 1 to 3 hours to make up my mind around that type of stock. While when it's business as usual and it's good results, I don't have to spend like 3 hours. I could review that within like 10 minutes and it's going to be fine.
Mike, I just want to add a question here, because we often say to not necessarily make decisions on emotions as investors. But in the case of BC, I used to own some of it, and I let it go because, like you've said, a lot of troubles were mentioned in the last quarters. And at some point, I was so confused and so like tired of thinking about it and frustrated that I just decided, let's not spend more time on it and just move on. Is that some kind of good decision based on emotion? Or
It's well, I'd say that if you don't want to deal with specific risk in your portfolio, it's probably time to let go of those stocks. When TD reported their earnings, I did a small episode on Moose on the Loose, and that's what I was telling. I was telling, like this anti-money laundering investigation is either a huge risk for the business or a great opportunity for investors. But then you have to deal with, do you want to have this type of risk in your portfolio? So if you have Procter & Gamble in your portfolio, you'll have to deal with cost of raw materials increasing, so pressure on margin, and you'll have to deal with currency headwinds. So those are the things that you will have to manage if you have an international company in your portfolio. With Bell, then it's like a debt problem, like it's a cash flow problem. So depends on which type of problems you want or a risk that you want in your portfolio, because no companies are perfect. They all have risks, and it's all about which kind of risks you manage better, emotionally speaking. And the other thing as well, and I came to that conclusion for a few of my holdings over the time, is when I keep thinking about a stock and I keep reviewing and asking myself questions, then I try to look at the big picture. And I did that with Disney and CAE a few years ago, where at that time of making my decision of selling both, they were, I think, was like less than 4% of my entire portfolio. So every quarter, I was spending more time on those two small positions, which were roughly 2% each, while they would not make a material impact anyway, going up like double digit or crashing by 50%, it would not have a material impact on my overall performance as an investor. And then I just thought, well, this is where I spend the most of my time. So literally applying the Pareto rule here, where if you spend 80% of your time on 20% like result, probably that you could cut that off and have a lot more time and feel a lot better about your portfolio. Because it's not just about the time here, but also the better you feel about your portfolio, the more confident you have in your strategy, right, and the higher the likelihood to stick to that strategy and keep on investing the same way. And it's all about this. There are multiple strategies at work. You have to find one for you and you have to stick to it. So making sure that you cut down the noise and cutting down all the negative emotions around your strategy is going to be a big help to stay invested, as we keep saying.
All right, so to end the episode, give us, please, a summary of how to read earnings like a pro.
Yeah, so you're going to start with the press release, of course, and the press release will cover the basics. So the revenues, the earnings, the highlights, CEO comments could be interesting, and it will be a very good point, a starting point to identify if there are any red flags that you need to dig further. Then you look at the investor's presentation, which is great because it includes graphs and visuals. So it makes it easier for you to understand, and you can see where the company is going, what they are more excited to talk about, like making a little more emphasis on the growth vectors. Then it's time to do a deeper research if there are any red flags or any questions that you have not found the answers. And those answers will be found in two places, either the financial statements or listening to the earnings calls. Now, listening to the earnings calls or reading the transcript would be very long. So what I've been using is I created my own ChatGPT to summarize those earnings, and I trained the GPT to tell me about what happened with the revenue, what happened with the earnings per share, cash flow and capital allocation, because I want to know like where the money is going and what they intend to do. So we're talking about dividend increase, we're talking about CapEx, we're talking about share buybacks. So all of this will be covered there. Segment performance, because I want to know which business division is doing better or worse, and strategic outlook. So what's going to be the next challenges, what's going to be the next growth vectors, and usually those are discussed during the earnings call. So instead of like spending like half an hour to listen to the entire call, I can get GPT to do that for me and narrow down the information to summarize it. So it's a good way to use artificial intelligence. It takes a lot of time though to train it properly. You cannot just say, hey, GPT, just like review Procter's & Gamble's earnings calls, because it's not going to work that way. So you need a lot of trial and errors. But at one point, once you have a really good trained one, it's amazing what they can do.
And I mean, as an analyst on Dividend Stocks Rock, it's really worth it for you. But maybe for individual investors, they need dividendstocksrock.com, right? So I need to mention it. So thank you, Mike, for sharing your pro tips on quarterly reviews. Listeners, if you're not ready to pay for a service like Dividend Stocks Rock, make sure at least to create a sustainable source of income at retirement by downloading the free Dividend Income for Life guide at thedividendguyblog.com/income. For the show notes and related content, visit thedividendguyblog.com/190. Next week, let's talk about telcos a bit more, and also REITs and utilities and which one to buy and which one to sell. So hit the subscribe button now to avoid missing it. And until then, stay invested.
Hey fellow investors, it's Mike here. I hope that you have enjoyed this episode. Please note that the Dividend Guy Blog podcast is at no time issuing buy or sell recommendation. Please do your own due diligence, as this podcast is recorded for information and hopefully fun purposes only. Make your research, make sure you do your stuff. We're not responsible for your losses or your profit after listening to this episode. And until next one, stay invested.